Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Manpreet and welcome to Cut to the Chase. Now the headlines might be about oil prices, but the most remarkable moves seem to be happening in the nickel market, a metal that's a key input into electric vehicle batteries and where Russia is one of the world's top exporters. The price of nickel spiked to over $100,000 per ton, a move that caused the London Metal Exchange to temporarily suspend trading. One article I came across said this move amounted to a 42 standard deviation move. To give an idea of how rare such a move should be, one financial market study noted that a 2 standard deviation move should occur once every 44 years, and a 6 standard deviation move, the so-called black swan, should only occur once every 4 million years. Now, I'm sure any statisticians listening will have an awful lot to say about such an analysis, so I'm going to move on quickly and talk about currency markets, specifically the euro. Now, recall that the euro has been a currency that has been amongst the most directly affected by the Ukraine conflict, given its exposure to spiking gas prices and to economies linked to the conflict, at least relative to other major Western regions. Now, the European Central Bank is set to meet tomorrow to set policy, and this is key for the currency given how important relative bond yields are for currency markets. The euro was already lagging a little on this front before the Ukraine conflict, with markets only looking for one rate hike in 22 versus up to 7 for the Fed at their peak. Recent events, though, call even this into question. Now, when the ECB meets tomorrow, we'd focus on two things on the outcome side. First is whether it tapers bond purchases, as previously planned, via its switch over to the asset purchase program, or whether it maintains a high level of stimulus. And second is what it signals in terms of the path of interest rates, given it faces offsetting pressures from elevated inflation on one hand and signs of falling growth confidence. On the positive side, though, reports yesterday that the European Union plans to jointly issue bonds to fund energy and defense spending did help create some support for the currency. Now, the euro-dollar pair is down almost 5% from its early February peak, falling through technical support below 1.09, with the next major support at 1.0635. There is a scenario where a break of this major support level could trigger a capitulation towards parity with the US dollar, though we'd most probably need a significant worsening of the Ukraine conflict for this scenario to play out. However, this may not happen immediately given the currency pair is oversold, an unwinding of which could trigger first a corrective rally back to 1.1. Amid the gloom, though, we'd also acknowledge the longer-term positive scenario. If the Ukraine conflict does not escalate significantly and the US dollar has peaked, on a full-year horizon, the euro could very well be one of the key beneficiaries of a weaker US dollar. So where these conflicting short and long-term outlooks leave us is that over a short 2 to 4 week horizon, we would continue to have a bearish bias, expecting a move in the euro dollar towards 1.08 first and subsequently to key support around 1.0635. We have a similarly bearish view on the euro against the Japanese yen, with technical supports around 124 and 122.8. That's short term though, but on a full year basis, once we're able to look through the impact of the Ukraine conflict, a peaking US dollar is likely to mean the euro dollar pair moves significantly higher, back towards 120. So quite a sharply different short and long term horizon, but please do have a look at our daily FX navigator for specific levels on euro currency pairs and more. But we'll take a pause there. Thanks again for listening. And if you enjoyed this podcast, please don't forget to rate and like it. We wish you a happy trading day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.